Okay, let's be honest. Nobody likes paying taxes. But if you want to buy a house, you got to show some income. Let's talk about it. Okay, first things first. I am not a CPA. But if you are a CPA, why don't you leave your information down in the comments below. And if anybody watching this video decides that they need a little bit of strategy talk with their CPA or needs a new CPA, then your information will be down there. Feel free to put that there. Okay, entrepreneur.com lists these 5 write-offs as the most likely write-offs to get you in trouble with the IRS. First, travel expenses. Second, home office use. Third, cell phone bill. Fourth, rent. And fifth, and most frequent, guard dogs. Yes, guard dogs. Some of the more common uses of write-offs are like mileage and depreciation, interest costs, utilities, those types of things. And those types of things are all written off, especially by small business owners. Those are the most common ones that I see. Okay, Ryan, what's the big deal about writing stuff off? Why does this matter? Well, I'll tell you why it matters. If you don't show any income, I can't prove that you can pay for that house. If you show a loss on your tax return, guess what? I cannot prove that you make enough money to pay for that house on paper. Look, I'm not saying you have to look like Scrooge McDuck on your tax return, okay? I'm just saying that in order to get a home loan, you're gonna need to show some positive income growth on your tax return over the previous 2 years from when you're applying. Okay, in that same vein, okay, Ryan, Mr. Smarty Pants, what kind of things can I deduct? Well, I'm not a CPA again, but what I will tell you is when I'm looking at and underwriting a loan, here's the 3 things that I can add back. I can add back depreciation, I can add back interest costs, and I can add back truly one-time expenses. If you have 5 years of tax returns showing a one-time expense, I can't write that off because then again, it's not a one-time expense. It's a 5-time expense. I add depreciation back because it's not an actual cash expense. You don't take money out of your wallet and pay an expense that's depreciation. Secondly, interest costs. If I'm pulling your personal credit report, you've got interest costs built into those payments. And so I'm going to add interest back because I'm already backing that out when I look at your interest, when I look at your credit report and I see your loans there. And then thirdly, those one-time expenses. If you have a business startup of some kind, or if you have a large equipment need of some kind and you have to buy a truck or a piece of equipment and you want to write all that off at once and your CPA says that's a good strategy, I can write that off. If it happens once, in a blue moon. If it has happened the last 5 years or the last 20 years or whatever it is, I can't write that off because then it's not a true one-time expense. Okay, Ryan, you've told me about the dangers of deductions. So how do I avoid that? What do I do to make this a more simple process? Well, the first thing you need to do is you need to sit down with your CPA and you guys need to plan. If you guys have a plan going forward, you can easily adjust your tax strategy to still take advantage of the tax deductions, but also show enough income on your property, on your tax return rather. So you're telling me how to plan, you're telling me to go sit down with my CPA. How do I determine how much income I'll have to show to buy this certain house? Well, that's where I come in. It's obviously too much of an explanation right now to do over the video. I don't want to bore you, but if you give me a call or shoot me a message, I'll be happy to look into that for you. Okay, guys, that's video 3. Thank you so much for hanging out with me through this. I hope you found this information beneficial. I hope that if you have any questions, there's some CPAs down below that maybe could answer those, or I can get you in touch with the guys that I use and trust. So bottom line is that deductions are great. They're a double-edged sword. They reduce your income and save you money there, but they also, if they reduce it too much, then it kind of puts you out of range for qualifying for the loan that you might want. So bottom line, if you're looking for a house, get with a CPA, make sure that your tax strategy is in line with showing enough income, and then you'll be good to go. And then call me. All right, we'll talk soon. See you guys. What was 4th? Travel. And 5th, guard dogs. Yes, guard dogs.